OG John AG is here. Silver did not just fall this week, it was smashed. It was dragged from $89 down to $76.6 in only 48 hours. That is a 13-day collapse. That is almost a 14.6% wipeout in 2 days. And for new investors who bought near the top, it felt like the floor disappeared under their feet. Phones started lighting up. Trading desks were hit with stop-loss orders. Retail investors started panicking. Comment sections filled with fear. People who were calling silver unstoppable 2 days ago suddenly started asking if the whole bull market was over. But listen carefully. This was not the end of the silver story. This was the signal. And not just any signal. This may be the most bullish signal silver has given us in months. Because when silver touched $89, it did exactly what we had been watching for. For weeks, the major level on this channel was $90. That was the next big test. That was the wall. That was the line everyone knew silver had to face. And silver came within $1 of breaking it. Then suddenly everything changed. The moment silver got close enough to threaten $90 with real power, Wall Street slammed the emergency brake. Not because the silver thesis failed. Because the silver thesis was working too well. $90 was not just a number on a chart. It was a psychological level. It was a structural level. It was the level the bullion banking system did not want to defend under full pressure. The same institutions that have spent years playing the paper silver game suddenly understood what was about to happen. If silver cracked $90 with strength, the market would immediately start looking at $100. If $100 broke, the old all-time high near $121 would become the next target. And after that, the short side math would become dangerous very quickly. So what did they do? They crushed it. They forced one of the harshest 48-hour silver sell-offs of the year. Not because silver was weak, because they were exposed. This crash was not the death of the silver bull market. This crash was the trap. And in the next few minutes, I am going to break down exactly how this move happened, why it actually confirms the silver thesis instead of destroying it, and why the investors who understand this playbook are calmly watching $76 while panicked retail investors are selling into fear. Welcome to the source code. Hit like, subscribe, and stay locked in, because what comes next in this silver market could be even more important than the crash itself. Now let's break it down properly. First, we need to understand what happened before the collapse. Because the move to 89 was real. It was not fake hype. It was not random speculation. Silver had been rising because of genuine structural pressure. Physical demand was strong. Industrial usage was tightening the market. Deficit pressure was building. The Bank of America real assets chart was showing levels stretched to 100-year extremes. Global liquidity had exploded by around $17 trillion. And earlier, short positions were being forced to cover as price moved higher. That move into $89 was legitimate. It was powered by real institutional flow. But silver is not a calm asset. Silver does not move gently when momentum arrives. It moves fast. It runs faster than gold. It runs faster than most major commodities. And when silver moves with that kind of speed, it creates pressure points in the market. At $89, 4 different forces came together to pull silver back down. 3 of those forces were mechanical. One of them was the real weapon. Let me walk you through each one. The first force was simple, psychological resistance. $90 was not just some random number. It was the most obvious technical resistance level in the entire silver rally. Every chart watcher could see it. Every trading algorithm had it marked. Every institutional desk knew traders were watching that level. So when silver got close to $90, smart money did not wait for retail traders to pile in at the top. They started locking profits just under the level. Big traders who had ridden the move from lower prices began selling into strength. Then the algorithms joined in. Once those sell orders started hitting, other algorithmic systems began front-running the late buyers. Retail traders were chasing the move, thinking silver was about to explode through $90. But institutions were doing the opposite. They were selling into that excitement. One sell order triggered another, then another, then another. Within hours, silver dropped from $89 to $84. That part of the move was normal market behavior. It was not manipulation. It was positioning. Major resistance levels often create this kind of reaction. Traders take profits. Algorithms respond. Momentum slows. Price pulls back. But that was only the beginning. The second force was the macro strike. For weeks, the US dollar had been weakening, and that weakness had been helping silver and gold. When the dollar falls, dollar-priced commodities usually get support. That is one reason silver had been able to move so aggressively. But then this week, the dollar suddenly bounced higher. Treasury yields moved up. Federal Reserve commentary sounded slightly more hawkish on the interest rate path. In April, inflation came in hotter than expected at 3.8%, the highest reading since May 2023. Silver does not like a stronger dollar in the short term. When the dollar rises, commodities priced in dollars face pressure. Gold feels it. Silver feels it even harder because silver is more volatile. Now, did the long-term macro picture change? No. The Federal Reserve is still trapped. Inflation is still elevated. Debt pressure is still enormous. Liquidity is still a major force. The long-term setup did not disappear overnight. But for a short window, the dollar bounced, yields rose, and Fed messaging gave institutional traders the perfect excuse to dump silver exposure. That phase pushed silver from $84 down toward $80. So at this point, we had two real forces, profit-taking at a major technical level and macro pressure from a stronger dollar. Both were legitimate. Both were mechanical. Still, nothing artificial yet. But the third force is where the picture starts getting more interesting. The biggest bullion banks in the world do not only trade paper contracts, they also operate vaults. They manage physical silver. They deal with real metal, and those physical vaults had already been under pressure after years of demand outpacing available supply. At $89, sourcing extra physical silver becomes expensive, very expensive. But at $76, that same silver becomes much cheaper. So ask yourself a simple question. Who benefits when retail investors panic and sell physical or paper silver into a sudden price crash? The institutions that need supply. The banks needed a reset. They needed a lower price. They needed panic selling to shake metal loose. And the easiest way to get that panic is to push price through levels where stop-loss orders are waiting. That is exactly what happened. Stop-loss orders were sitting below major support zones. Once one level broke, automatic selling kicked in. Then the next level broke, more stop-loss orders were triggered. Then the next one, $80 broke. Then $78 broke. Then $76 got hit. This is one of the oldest tactics in institutional trading, stop-loss hunting. You push price into known liquidity zones. You trigger forced selling. You let the market panic for you. Then you buy from the people who were forced out. And the silver chart this week showed that signature clearly. If that vault restocking piece made your jaw drop, hit the like button right now. This is exactly the kind of market structure breakdown that rarely gets explained in simple language. Sharing this video helps the source code reach investors who need to understand what is really happening behind the silver price action. Now we get to the fourth force. And this is the real weapon. This is the force that turns a normal correction into a violent collapse. The Chicago Mercantile Exchange, better known as the CME, controls the margin requirements for silver futures traders. In simple terms, if you trade silver futures, you must keep a certain amount of cash posted as collateral to hold your position. In normal conditions, those margin requirements stay relatively stable. They are supposed to reflect the usual volatility of the asset. But the CME has the power to raise those margin requirements whenever it chooses. And historically, when silver approaches major breakout levels, the same playbook shows up again and again. Margins get raised. The mechanism is simple but brutal. A trader may already be holding silver futures with enough cash posted under the current rules. But if the CME suddenly raises the margin requirement by 30% or more, that trader now has to deposit fresh money quickly. If they cannot add the extra cash, their position gets liquidated. Not because they changed their mind. Not because the silver thesis broke. Not because physical silver demand disappeared. But because the rules changed in the middle of the game. And when those positions are forcibly closed, they are sold at whatever price the market gives them. That forced selling pushes the price lower. Then the lower price triggers margin calls for more traders. Then those traders get liquidated too. That creates a domino effect. One margin decision becomes a wave of forced selling. And that selling has nothing to do with physical silver fundamentals. It has nothing to do with real long-term demand. It is paper market pressure. This happened in January 2026 when silver collapsed from $121 down to $74 in a matter of days. The trigger was a CME margin hike that set off forced liquidation across the silver futures market. It also happened in 2011 when silver was approaching $50. The CME raised margins 5 times in 9 days. Cumulatively, margin requirements jumped by more than 80%. Silver collapsed from around $49 to $34 within weeks. And the 1980 Hunt Brothers silver event ended through a similar rule change dynamic when the exchange changed the conditions of the game to break the position. This week, as silver approached $90, the same kind of playbook appeared again. Margins rose. Forced liquidations followed. What started as normal profit-taking and a dollar bounce turned into a full paper market collapse. That is the key distinction. This was not the physical silver market collapsing. This was the paper market machine doing what it always does when silver threatens a critical psychological level. And here is the part almost nobody is talking about. Every major margin hike silver event delayed the move, but it did not permanently stop it. After the 1980 break, silver eventually returned to triple digits in 2011. After the 2011 break, silver eventually reached 121 in 2026. After the January 2026 crash from $121 to $74, silver came back to $89 within 4 months. That is the pattern. The mechanism delays the move. It does not erase the forces behind the move. And right now, those structural forces have not weakened. They have become stronger. Real assets versus financial assets are still sitting at 100-year extremes. Global money supply still expanded by around $17 trillion over 24 months. The industrial silver deficit is still in its sixth consecutive year. Shanghai silver premiums are still near multi-decade extremes. None of those drivers vanish because paper market margins are raised. None of those forces care about a forced liquidation event. The crash did one thing. It transferred silver from nervous hands into stronger hands. Retail investors who panicked sold into the decline. Institutions that understand this playbook had the chance to restock and reposition at $76. The same banks that helped create the panic are the ones able to buy back lower. That has been the pattern again and again in silver history. If you sold into fear this week, you may have sold directly into the hands of the same institutions that wanted this discount in the first place. Now here is what investors need to watch next. The first signal is the weekly close. If silver closes back above $80, that tells us the correction was short-term, the consolidation is healthy, and the breakout structure remains alive. But if silver closes below $74, that would suggest macro pressure is stronger than expected, and the market may need more time before the next leg higher. The second signal is the dollar index. If the DXY turns lower again from current levels, silver gets immediate relief. The dollar headwind disappears, and metals can regain momentum quickly. But if the dollar keeps strengthening, silver may need another consolidation phase before attempting another breakout. The third signal is COMEX silver open interest. When forced liquidations happen during margin hike events, open interest usually gets reset. Weak hands are removed, leverage gets flushed out. If open interest remains compressed over the next few weeks, the market can become mathematically loaded for another acceleration phase. The fourth signal is junior gold miners. Watch GDXJ. If junior miners hold above their breakout trend line, it tells us institutional positioning has not been destroyed by this paper market chaos. But if miners start failing alongside metals, that would mean the broader structural rotation is delayed. And finally, watch the gold to silver ratio. If the ratio moves back below 55, that confirms silver outperformance is returning. But if the ratio stays above 60, it means gold is taking leadership again while silver cools off. Do not look at one signal alone. Watch them together. The weekly close, the dollar index, COMEX open interest, junior miners, the gold to silver ratio. Together, those signals will tell us whether silver is preparing to retest $90 soon or whether the market needs one more consolidation before the next move. The investors who panicked at $76 handed their silver to institutions that understand this game better than anyone. The investors who recognize the playbook are not looking at this crash as the end. They are looking at it as a discount. The macro thesis is still alive. The structural drivers are still intact. And the setup may actually be stronger now than it was at 89s. Because at 89, the easy move had already happened. Late buyers were chasing. Emotions were hot. The market was crowded. At 76, the fear is back. The weak hands have been shaken out. The next leg is being reloaded. They did not defeat the silver bull market. They changed the rules for one more cycle because they needed time. And every time this happens, the eventual move that follows tends to be even bigger than the move they tried to stop. Now I want to hear from you. What are you doing right now? Are you accumulating into this discount? Are you holding through the volatility? Or are you sitting in cash, waiting for confirmation? Drop your thoughts in the comments. I read every single one. Subscribe to the source code and ring the bell so you do not miss the next breakdown when this silver story develops further. Hit the like button before you leave. John AG out.